with that 25 basis point rate cut expected later this week, it's a good time to consider bringing your cash investments off the sidelines, perhaps. Here with the top reasons he thinks fixed income is a good place for investors in 2025, we've got Dominic Pappalardo, who is the Morningstar Chief Multi-Asset Strategist. Dominic, thanks so much for taking the time here today. So why consider owning bonds as interest rates come down?
Yeah, thanks for having me, Brad. A few reasons. The most obvious one is there's no longer a yield give up to move out into longer maturities. For much of 2022 and 2023, the curve was inverted, meaning short yields were higher than long-term yields. That's sort of normalized now, and the curve is pretty much flat. So cash rates are around 4.3%, and really any maturity along the yield curve is in the 4.2 to 4.4% range. So there's really no cost to making that trade today.
You know, as we think back to last week, U.S. Treasury yields rose to the highest level since late November, as I'm reading through a note from UBS in my inbox here, even though markets remain convinced that the Fed will cut interest rates further when the FOMC meets this week. How should that be priced into or play into investors' strategy here as they think about this specific asset?
Yeah, Brett, we would agree that more rate cuts are likely to come, particularly through the first half of 2025. And what those rate cuts represent is the opportunity for those longer maturity bonds to actually show price appreciation. So whereas cash can only generate total return through a function of income, longer maturity bonds could produce total return from income as well as price appreciation, which should occur as rate cuts are realized. And additionally,
Sorry, go ahead.
I was just going to say also those cash rates will also decline as rates are coming down. So even that 4.3% cash yield that's available today will dissipate rather quickly as further rate cuts come down the line.
How can investors identify quality bonds and kind of pair that with the expected returns?
Yeah, if an investor is focused on quality, we'd be proponents of adding to U.S. Treasuries. Obviously, they're relatively risk-free as they're backed by the U.S. government. And the yields there are appealing on a real yield basis, meaning that the actual yield of those bonds, even after the current inflation rate of about 2.7%, still generates a positive return for investors. And certainly, there's more volatile options in the marketplace away from those high-quality bonds that we could talk about. But if an investor is risk averse, we would say U.S. Treasuries are the way to go.
And so how would you then identify some of the emerging markets as well?
Yeah, we like emerging markets more than we like U.S. corporate credit. Some of the emerging market debts, when you look through that valuation lens of real yields, Brazil, for example, has 5-year bonds yielding over 14%. Mexican bonds are yielding around 10%. And they both have inflation rates around the mid 4% range. So very attractive real yields. Again, those countries will be more volatile as they're rated below investment grade. But for investors that can accept that risk, there's definitely some upside there. When you compare that back to, let's say, high yield corporate bonds in the US that are also below investment grade, their valuation metrics when using credit spreads or the additional spread over treasuries is very, very low. It's in about the 5th percentile of history, meaning that additional compensation for the credit risk has only been lower 5% of the time over history.
Where do you think the real mix and a sweet spot for the mix of a portfolio holding fixed income is right now, especially as you've got some of the largest institutions now initiating their own, not coverage all out, but their own recommendations on how much Bitcoin and cryptocurrency versus fixed income versus equities should be held?
Yeah, Brad, we really still like the intermediate range of high quality bonds. When you think about how that fits into a diversified portfolio, fixed income today, because of the yield rise we saw in 2022, is able to offer some hedging protection. So if we get an environment where, let's say, equities become volatile and see prices fall, we would expect that high quality fixed income allocation to rally and really offset the losses being experienced from the equity side in some ways. That didn't exist. That protection wasn't available when rates were near 0%. But now that we're back to the mid 4s, there's room for those rates to fall and provide that ballast to a portfolio. And we think that's a prudent choice to make. And we would remind investors to treat fixed income as something that could be conservative and helpful and not just chase those high yields that we talked about in emerging markets. That may be an area where investors could dabble or add some plus exposure, but that shouldn't be the core fixed income allocation within a diversified portfolio.
Dominic, really great insight and analysis. Thanks so much for taking the time.
Thanks for having me, Brad.